Good morning, Jags. This is Fahad. Today is Monday, March 15th. Let's get started. A high quality, well established medtech, a beneficiary of improving growth trends as COVID goes away. Zimmer Biomet, a former Jaguar top pick. Zimmer Biomet symbol ZBH. That's what I want to look at this morning. A quote comes from Bank of America this morning, and while I read this quote, take a quick look at the technical picture on this chart for a potential breakout, or you can keep this picture in your focus as well. Bank of America said this morning, today there are about 1,200 large joints robots in the United States. We see the potential for over 5,500 installations ultimately in the US, or nearly 5 times the current installment base, and as much as double that outside of the United States. Today, only a single-digit % of Zimmer Biomet's US total knee implants use robotics or cementless versus mid 40% for Stryker for both. When we just consider the potential impact on Zimmer Biomet's growth rate from mixed gains and capital sales from higher penetration of robotic surgery, cementless knees and sensor-based implants, we think Zimmer Biomet could see an incremental 2 points of growth in 2022. For perspective, Zimmer Biomet was only growing about 2% pre-COVID, and that mixed math does not contemplate the impact of higher demand from the backlog of COVID delayed cases, which sums to us as much as $700 to $800 million of incremental revenues for Zimmer Biomet alone. We think the back half of 2021 and 2022 could be a very exciting time for Zimmer Biomet. There you have it, unquote. Now, there's a very important message over here. Let me give you a quick background. When this company reported earnings, Q4 earnings, which you can see right over here, this was around February 5th. In that Q4 earnings, the company beat expectations. They were slightly better than a street estimate on the revenue side, with total knee revenues at $737 million versus $728 million. Hips revenues were $504 million versus $501 million. And similarly, dental, trauma, and other categories, which are smaller businesses, all were slightly above the consensus view. However, in the earnings call, as I read the transcript this morning, Zimmer Biomet was very conservative regarding Q1 revenues. In fact, they guided that we could see a potential, small few percentage decline year over year in total knee procedures and the total revenues. It's very subdued, very conservative. Why? Because when the management issued this guidance in early February, which they probably compiled sometime in late January, we still had New York closed, Michigan closed, most of the country closed, Europe was completely shut down and everything. So based on the information that was in front of them, they guided conservatively. But I believe this Q1 guidance set the bar too low of expectations, because as the quarter has progressed, we have seen everything gradually and rather at an accelerating rate come back to life. Remember, the vaccination charts have started to roll over after January 21st. And this company set the guidance, low guidance, with a year-over-year decline on February 5th, 2 weeks later. And since then, charts have continued to come down, all COVID charts, and business has returned back to normal. So first, there's that case, which is that they set out a very conservative guidance. Secondly, it is undeniably no question that there's a pent-up demand for total knee procedures, people that wanted to get it done last year, but now they will be coming back. So once we have set the floor for the guidance, and as we emerge from that and inflect to positive growth after Q1, I don't think you're going to see this company return back to 2% year-over-year top-line growth, which we used to see back in 2019 before COVID happened. I think you will see accelerating growth. You could see high single-digit growth, maybe even double-digit growth. There's several reasons for that. Number one, Even as they lowered the guidance. In the earnings call, management said that Zimmer Biomet's total knee procedure is actually taking market share from Stryker, as much as 800 basis points of market share with limited procedural growth at that particular time. Number two, this company's key products, is only currently approved for one category. Many people don't realize that, but in case of Zimmer Biomet, they still have the opportunity to take share in many different ways. So I'm just going to look up something here real quick. Their ROSA TKR platform currently is only approved in the United States for TKA, or total knee application procedures. On the other hand, Stryker is partially approved for knee, partially approved for total knee, and partially approved for hip. The other two categories, Zimmer Biomet's ROSA is currently not approved for. The applications for such approvals are expected to happen gradually throughout this year. We do not have firm time frame of that, but we're going to start to learn more about this. That's going to give this company even bigger piece of market share at a time when post-pandemic demand will be recovering, pent-up demand, and growth will be accelerating from negative after this set the low bar of expectation for Q1 and going into potential high single-digit growth or even double-digit growth. And then the last third piece is that in 2022, in the earnings call, management mentioned that they're going to be spinning off their dental business, which is a low margin, low growth business, and it's got nothing to do with the knee procedures. So they want to divest out of that. It's not a very fitting business model with the current products the company has in play. Not only they'll be able to raise a ton of cash when they do that, approximately $3 billion by my estimate, but on top of that, that's going to improve the overall productivity and margins of the company by as much as 1,200 basis points. I don't think that's factored into the profitability calculations on the street for year 2022. So in out years, profitability margins for this company will be much, much stronger. Put it all together, chart is looking nice. It's starting to break out. The street is going to start to warm up to this name after Q1 results come out, because everybody will realize that the bar is now set low, and from here, sequentially, growth is accelerating. I expect a breakout in this name, and I think this is eventually going to $190 to $200 per share. It's currently at about $163 per share. That's it from me. Let's go to Jay.
Morning, everyone. So today, just wanting to provide an update, another one on Century Casinos. Ticker on that one is CNTY. So back on November 7th, posted a homepage article. I also included it in the November 8th weekend research. Then on December 23rd, covered it in conversations. January 29th, covered in conversations. Last Friday, the company reported their Q4 earnings. Stock was higher by close to 10%. So let me just give you a quick breakdown of each of their segments, or each of their regions, I should say. In Colorado, this includes their Cripple Creek, Central City casinos. Net operating revenue was up 20%. Adjusted EBITDA more than doubled to $3.4 million, and their EBITDA margin jumped from 20% to 36%. Management said they saw a significant increase in time on device and players spending more per visit. Market share went up in both of these markets, but most significantly in Cripple Creek from 10.5% to 13%. They also mentioned that one of their 3 sports betting partnerships is already up and running. The other 2 plan to launch later this year. And in a couple of months, on May 1st, Colorado casinos will be allowed to remove the current $100 maximum bet limit and introduce new table games such as Baccarat. Table games currently comprise less than 10% of total gaming revenue, which is well below the 25% in other regional markets. So there's potentially some upside here for their Colorado operations. Moving on to Missouri. They grew net operating revenue by 3% and adjusted EBITDA by 31%. The primary driver for these results was an increase in the average revenue per player of approximately 40%. They said that handle pulls per hour increase guests appear to be playing slightly faster and betting more, which is driving the increase in revenue per player. Then finally, moving to West Virginia. This includes their Mountaineer Casino Racetrack and Resort. It was a bit soft in the quarter, but from what management said, this seems to be the one casino that appears to or is going to benefit the most from the reopening trade. Because they called out the over 60 demographic coming back, feeling more comfortable. Also, seasonality wise, Mountaineers' best quarters are in Q2 and Q3, so there can be potential upside there. Also, they have sports betting, online gaming, partnerships with William Hill and Rush Street Interactive expected to go live next quarter. And then finally, their international operations, which include Canada and Europe, they had a difficult quarter because they were pretty much closed the entire time. However, the catalyst you're going to want to pay attention to is management remains in discussions for a potential sale of their Poland assets, with an announcement potentially on the way in the next 4 to 6 weeks. And Stifel was out with a note also highlighting that they believe Century also remains active on the M&A front, with further acquisitions of U.S. regional assets potentially coming this year. So between these two catalysts, they would expect shares to re-rate closer to regional gaming peers.
Excellent update, and what a winner this has been. Looks like, first of all, on this update, all the regional casinos are on track to continue to accelerate growth rate as we reopen the economy. Some regions are faster than the others, but generally speaking, everything is firing on all cylinders. So, and look at this trends, folks. On November 7th is when this homepage article was presented about Century Casinos, and every single thing that we saw in the growth and the trends at that point. And you can see this stock at the time was trading at $5.40, and it was just starting to break out from downtrend resistance. And here we are, the breakout continued. Now it's trading at $10.10, and the story has continued to improve since then. So kudos to you, Jay. Almost doubled this position since November 7th. And then also followed up with that note in the weekend research, which came out later, with further discussion about what we saw in some of these properties, Missouri, West Virginia, Canada, Colorado, and all of them. And so that was also presented on the weekend research. Now, with all of this said, I think this reopening recovery theme still has legs. I think that many people are starting to jump to conclusions very, very quick, particularly in the travel and recreational area, that we're going to start to see topping price action. And I understand that that may be simply by looking at chart, because a lot of these stocks are up so much and the RSIs have gone up so much. But I keep emphasizing, as I've done many times now, with regards to airlines and hotels and parks and casinos and all of that, everything in travel, that there's a pent-up demand, and everybody is now holding $1,400 stimulus checks that are going to start just coming out within the next week or two, after it was passed by Biden administration within the last week essentially. So there's going to be a pent-up demand for travel. It's going to stay with us, and any kind of peaking of multiples won't happen, in my view, probably until middle of the second quarter or late second quarter. That's when we could see tech starts to outperform again, and maybe value and travel starts to slow down a bit. That's just my high-level view on that, but great update. Let's go to Chronicle.
Morning. We received questions regarding a couple stocks that were previously discussed, so I'll just address them here. First company is MTBC. I first talked about this one back on January 14th, and although it worked for a while, going from 950 to 12.5, it's since come back down due to the recent volatility we've been seeing. So first thing that needs to be emphasized here with regards to the recent decline in the stock is that, as compelling as the company's growth potential is, they're slightly in the red in terms of profitability, which I suspect is why it got lumped together with all the other momentum stocks that sold off from the higher rates. However, the good thing is that MTBC is not a levered company. They have about twice as much cash compared to debt, so that there shouldn't be any concerns about liquidity. And one more thing before I get into the proper update is to take note that starting on March 29th, MTBC is going to be changing its name to CareCloud to match its business more appropriately, but the ticker is going to remain MTBC. Now, getting into whether or not we remain bullish on the stock, the short answer to that question is yes, we continue to like it, and here's why. First of all, the company continues to be misunderstood in the sense that the market doesn't like how management keeps doing acquisitions because it tends to result in immediate drops in margins. So looking at the graph that I shared back then, we can see that every time MTBC did an acquisition, the margins will drop right away. But on the flip side, it's easy to forget that management is extremely efficient at synergy and integrating the new acquisitions, which is why margins have always consistently rebounded within a couple quarters of their M&As. So that tends to go ignored. The main predicament here is that the market doesn't seem to be able to accept that acquisitions are going to remain the core component of the company's strategy, because traditionally we tend to group companies into one of two baskets in terms of growth. We either have companies that are mainly organic growers, and then we have companies that rely mainly on M&A. But in the case of MTBC, this company is sort of a hybrid where they're doing all this M&A, but with the intention of eventually growing organically at a high rate by doing lots and lots of cross-selling and upselling with their acquired customer base. However, what the market seems to be fixated on is the ongoing suppression of margins and hence cash flow, because they're approaching this company with a value mindset. Whereas we, as in Jaguar, we believe that MTBC has to be eventually viewed as a growth company with future cash flow potential, as it continues to report strong top-line growth quarter after quarter. And so that is where the main disconnect is coming from, present versus future. And even if we want to analyze the company from a margin perspective, the correct way to go about it is to isolate the healthcare IT segment to strip out all the noise from the acquisitions. With regards to the latest commentary from their earnings a couple weeks ago, management themselves expect gross margins to return to between 45 and 50% over the next several quarters. And the CEO, Stephen Snyder, would also emphasize that they are becoming more efficient in the sense that the customer acquisition cost ratio is now at 2 to 1. So basically, the company is generating $2 in recurring revenue for every dollar spent in sales and marketing, driven mainly by upselling. Whereas the ratio for their competitors is typically only 1 to 1. So I think management is owed some slack here in terms of doing frequent acquisitions. And then one last important point, management also made it a point to reiterate that the range of its services supports both small offices as well as large corporations, especially now that they've taken CareCloud under their wing. And I think what's going under the hood as a result is that the company's back office is becoming capable of delivering different levels of functionality based on what they call a dynamic sliding scale. And what this does is it matches the cross sections of various individual doctors and physicians' offices to multi-office clinics nationally. So the implication here is, of course, even more cross-selling and upselling opportunities down the road.
You know, very interesting stuff. And the big highlight from this discussion is essentially this. First of all, $136 million in market cap and $105 million in revenues. So on the surface, anybody that looks at it right away, the conclusion is, wow, this is cheap. It's trading at only 1.3 times its revenues. And then they look at the total headline revenue growth rate, and they find out quickly that the revenue grew last year, 2020, by 63% year over year. With a growth of that magnitude and trading at only 1.3 times sales, that's pretty cheap, right? But then what this discussion illustrates is that there's a major trade-off over here, because a significant part why the company's revenue was 60% and growing is because through all of these acquisitions, which has depressed margins. At some point, I think the street wants this company to stop doing these acquisitions, right? Or maybe slow down materially so we could see the benefit on the margin side from scale. and grow organically rather than just through acquisitive activity. If they do that, I don't think revenues will stay at 60%. It's going to return to what that normalized rate should be. And I think that's the question. Would it be 20% year over year, 10% year over year? What should be that normalized growth rate on the or organically? But then the counterpart is margins will grow to 45% long term. I believe, what are they now, right? 32, 31% currently. So significant potential here for the margins, organic growth to continue to move higher. Profitability will improve. So there's a trade-off right there. And I think this mix, I don't know, honestly, if management has opted to continue to listen to the street or just keep doing this acquisition. I think they're just in the early phase of growth right now. They want to keep spending. They want to keep increasing the moat. So it's going to be a very interesting case of watching for the next couple months to a year exactly what kind of behemoth this becomes. But I do believe overall, no matter how you dice it, it remains an incredibly attractive opportunity with a very low downside risk potential, given a strong management and how they're doing this. And they're in the telemedicine area and all this other stuff, which are all hot markets currently. Is that the only one you had, Chronicle, for today?
So the second company we had a question on is Sinopec, ticker SNP.
Okay.
This was a JaguarMedia video from November 12th, and essentially the question was whether or not to take profits or whether we should worry about potential risk of delisting. So first of all, just take note that the company has yet to report Q4, so we don't have the latest financial information yet. And also historically, this management doesn't provide guidance, nor do they provide much of a qualitative outlook, which is pretty common practice in Shanghai and Hong Kong, especially with the state-owned as well as Tencent-backed players. But looking at consensus estimates, Sinopec is currently expected to report a greater than 50% decline in revenue to about $376 billion for last year, followed by 15% growth in 2021 to $432 billion. I think they can do better than that because it's important to keep in mind that the company is not only a beneficiary of higher oil prices and domestic refining. In fact, the IEA is expecting China to overtake the US as the world's largest refiner this year. But as Fahad and I discussed previously, Sinopec also has a sizable chemical segment that deals in ethylene and synthetics. And that's also seeing pricing tailwinds as Asian ethylene prices have surged above $1,200 per metric ton in recent months. And it's mostly because the Australian and MENA region refineries are still being slow to come back online. As it stands, the US and China are the only major players that are witnessing their refineries back to operating at nearly normal levels as of early March. So I think in terms of oil and petrochemical fundamentals, this stock should logically continue to move higher as long as prices remain elevated. Currently, the refining break-even price for Sinopec is estimated to be in the mid-50s, so I wouldn't be surprised if they report similar operating cash flow levels to 2017-2018. Plus, the valuation of the company is still extremely low at 0.25 times sales and 7.5 times EV to EBITDA. And on top of that, the company also pays a fantastic dividend at over $4.20 per share annualized. So if anybody bought the stock back when we recommended it in November, when it was in the mid 40s, then you would also be enjoying a 9% dividend yield in addition to all the capital gains so far. And historically, management tends to have between 60 to 70% payout ratio, if that's your thing. So I hope that answers the first part of the question. My inclination would be just continue staying long and keep a trailing stop. Now to quickly address the second part of the question, which is whether or not there's a risk of delisting. I think this was a genuine risk under the Trump administration, given how they were playing 6 degrees of separation with the Chinese military. But judging by the latest commentary, I think the Biden administration is going to be less hawkish in their actions because it's looking like the White House is currently focused more on fiscal stimulus and domestic issues. And it does seem like they're going to be a lot more targeted when it comes to assessing which specific Chinese companies to punish if it comes to that. It's a difficult question, and geopolitics can be unpredictable, but what I will say is if they do announce a delisting, you will have plenty of time to get out because there's going to be a lengthy grace period. It's not going to happen right after the announcement. So I don't foresee extreme volatility in such an event.
Yeah, I agree with that. First of all, I don't think there is any kind of delisting risk around many of these Chinese companies. I think there was a lot of air under Trump administration, and you're right, there's a big grace period. Folks, on November 12th is when a exclusive bull case, long-term bull case was presented for SNP. You can see right here. And at the time, the stock was trading at 45, and we mentioned that this could trade as high as $100 per share. Which basically was simply looking back at where the stock used to be many years ago as the oil market improves. So this is the long-term trajectory. I still believe that S&P is going to continue to go higher. And the most important point from this presentation from Chronicle, this update, is about refining margins. And those are direct plays on inflation as well, reflation trade essentially. As they go up, profitability goes up, plus you're getting fat dividend and capital appreciation. So I think from a technical standpoint, I expect this to move into this air pocket and go all the way to about $71 per share. So more upside is coming. Fantastic stuff. All right, folks, we're going to stop over here. Thank you very much for joining. We'll see you in the chat room shortly.